Good evening, everyone. Time for another silver update. We are looking at a breakout from the cup that I had noted previously. The breakout was consistent with the previous breakouts that we've had. It hasn't run as far percentage-wise before it pulled back, but I just wanted to point out to you the pattern that we see on these sorts of moves. So I've got a longer view. I'll come into a closer view in a little bit. If you look back at this cup, we had a pretty clear breakout from both sides of this cup. Very strong move. And we tested back right down to the point of the breakout. Now, if you remember what I was talking in the last few episodes about the line of least resistance that Livermore was talking about, this is the point, or as I referred to my reverse battering ram theory, this point is where that occurred. Now, we had a breakout. Now, you've got to understand that Livermore is a technical trader. He prefers to buy on breakouts. I'm sure if he were adding to a bull market run and he wanted to add on the dips, then he could, but he really was a short-term trader. In his early stages in the bucket shops and just as a trader in the brokerages, he would have bought right here and he probably would have sold somewhere in here. But for the long haul, he would probably also have added here. So what you're looking for in these moves is a breakout, hopefully on good volume, strong breakout, and you're looking for a retest. This is actually your best buy point right here. If you're a technical trader and you're looking to buy a breakout, you actually want to wait for it to come back. One of the reasons why Livermore didn't like that is because sometimes the market does not come back. And I'm going to show you on some of these others why that's very difficult. This one right here is textbook, the way it's supposed to be. You had a perfect opportunity to buy right here, and it was smooth sailing from there. But you could have also bought here, set a stop down here. And this is all technical terms I'm using. We're not using stops because we're buying physical, but to compare the two. So, nice pattern here that we had. We had another one here, and you can see we had our breakout, our technical breakout. They actually piled on, actually before we got through the door here, they just piled on and blew right through. Had a nice little pullback here, not all the way back, and then we took off to the upside. Same pattern, same sort of thing. Another minor one here, but it's too small, so I didn't include it. And we're now to our latest one here. So I'm going to pull in a little bit closer to take a look at this one. Get a little bit closer. And with this one, you can see we had a nice little break. Percentage-wise, not that good because we should have been up in here or higher before we pulled back. But as you know, and I'm going to address this in a little bit, they raised the margin requirements and that caused everybody to go into a tizzy, which I think is ridiculous, but I'll talk about that later. But we broke out, a nice breakout, and we came right back and tested, and now we're rallying. Now, could this be a reversal? Yes, it could. Odds are it's not because it is a bull market. But get a little bit closer in and you can see nearly a perfect test of the breakout line. And now we're coming back to this high breakout point. So I honestly expect this MACD to round to the upside and go higher. We might not. We might get a pullback from here, a further pullback. I think we got $2. It's kind of interesting to see. We've got 38. What did we get here? We got about 38.17 on the high, and we've got about 36.81. Almost $1.50. We're looking at a $1.50 swing here. And if you remember, for those of us that started buying around $4 and $5, $1.50 move in a day is absolutely unheard of. The only time we ever had that was back when Buffett bought his 100-something million ounces. But we had an announcement today of a margin increase on silver and I wanted to point out this article at Zero Hedge. And like clockwork, CME hikes silver margins, halting surge. And all kinds of conspiracy theories are thrown about and all this stuff. But I just wanted to dispel some of that just to explain how this works. Now, if you note here, silver futures were 11,000 and 8,250, went to 11,745, 8,700 respectively. These are maintenance margin and margin. I think actually these are a different margin than that, but it doesn't really matter. So I wanted to take you to the CME site, and this is the CME site on the silver futures. It gives all the specs on the silver contract. Now you want to note that this is 5,000 troy ounces. That's the standard contract. It's not the only contract. There's a 1,000 ounce. There's also, that's the mini, I think, and they're not just traded on the CME. They're also traded in London. I think there's one on the New York. There's different contracts, but we'll just look at the CME because that's the biggest one, which I think that's the Chicago Mercantile Exchange. So it's a 5,000 ounce contract. Now we know that the price of silver is around $37, so you're talking the outright value of this thing is 37 times 5,000. So I did a little math, and I want to show you what I did. There have been a series of hikes, and I'm not going to detail all the hikes. There have actually been 5 hikes since last November. But I just grabbed a couple of them, including today's, to make a point here. So this is just a little math that I did. What I've got here is the original margin requirement. This is actually before November 9th. This is after November 9th. And this is today's. Now, I think there were 2 more. There was one in December, one in February. It doesn't really matter because I'm just trying to make a point here. If you take 5,000 times the price of silver at that time, which I think I used 25, you come up with the total value of that contract is $125,000. So if you take all of those 5,000 ounces and multiply it by the price at the time, the value of one silver contract is $125,000. Now, to carry that contract, you had to put up $5,000. So that's 4%. You're putting up 4% of the money it takes to control that. Now, let's look after November 9th. They raised it $1,500, and the price I used was about $27, and it's a rough guesstimate. This is all rough, but it's just to show you something about the percentages. Now, if we use the $27 multiply times the 5,000, we get a total value of the silver contract of $135,000. And the margin on that is $6,500. That's 5% of the value. So that's a 1% increase. Now let's jump to today. They raised it to $8,700, but at $37, or did I use 38? Maybe I used 38. Yeah, I used 38. So 38 times 5,000 is 190,000. But that's only 4.5% of the value of this contract. 8,700 is only 4.5% of 190,000. So this is the point. Although people are getting crazy and yelling and screaming about the conspiracy and all this stuff, the point is this. The CME is required to make the margin a reasonable percentage. Now, for the most part, any of you who've traded futures know that generally it's 5%. They like to keep the initial margin around 5%. Now that's a lot of leverage. That's 20-to-1 leverage. So for every dollar that you put up, you're controlling $20 worth of silver. So you can see here that we're still below 5%. So here's the point. If you have a commodity that is gaining price rapidly, such as this one, let's look on the daily, let's look on the weekly. you are going to see a lot of margin requirement increases. Now, this all could be avoided if the CME or the other exchanges did a percentage basis and said, for example, the margin will always be 5% of the price. The problem with that is that the margin would change daily, and that's just kind of ridiculous. So that's why they change margin requirements. Now, people will argue, well, they shouldn't have done it in the middle of the day, and it shouldn't have done it. It doesn't really matter. So, as people have speculated on Zero Hedge, they've talked about how this is an attempt to stop the silver bull market. If it really were such, then we'd actually see these percentages rise. 6, 7, and to tell you the truth, that's what I would like to see. Because if these started to approach 100%, in other words, if you had to put up 100% of the money to control it, so here, one contract is $190,000. If you had to put up $190,000 to buy one futures contract of silver, that would be 100% margin. And if that were the case, then at that point the paper market will have met the physical market. And there, except for convenience sake, there would be no reason to buy the futures market at all. You just simply buy silver in the cash market. And so many people on Zero Hedge have speculated, yes, we're going to get to the point where the margin requirements just make the futures equal cash. But my point is this: we're not anywhere near that. This margin requirement here should be about, if we were doing something like that, to be at 10%, this should be $19,000. It's not anywhere close to that. So I know everybody loves a conspiracy and everybody loves the evil silver bears and all this stuff, but really the CME is just simply responding to this price rise, this dramatic price rise that we're seeing in silver. We've got a healthy pullback. It did coincide with the rise, which is normal because people who were long silver in the paper would have had to put up more money by the end of the day to carry their long contracts. They would have put up more cash. And I don't know if this is the active month, what month we're looking at here. We could probably do a show of the volume. It looks like it's probably not the nearby month. I don't know if March is gone or not. I don't keep track of those dates and stuff. But if there were people still in the March, then it would be in their interest to just get out and just get flat. So it's normal to see a reaction on a margin increase date because a certain number of the longs, but then again, maybe a certain number of the shorts just don't want to put up more money, just want to get out and take what they've got. So pretty normal sell-off, not a big deal. Back to the breakout point. We would expect, since we're in a bull market, we're going to rally from here, go into new highs. My projection on the swing rule was 40. I actually think, and that reminds me, I wanted to share one more thing here, that since we have broken out of this latest move, I'm going to have to move back in to show you. That's too far. And I think it's going to be on the daily. As you can see on the MACD, we've broken out of this downtrend and we're continuing up. You can see it on the weekly MACD. You see how we've broken again and gone up more. The MACD is going higher. So this is not a top. This point here is not a top, like this point and this point and this point. It's proven itself not to be that. So the question is, what is it? Is it a continuation of a parabolic move? Now, I think it is. I think we're in a parabolic move. Remember that a parabolic move is a curve. And ultimately, a parabolic move will approach infinity. Infinite price in zero time. That's what you're looking at. ultimately if a parabolic move goes all the way. They also tend to crash in the same direction that they went parabolic. So this is the longest chart we have. And what I'm trying to point out here is that this is not the top of a parabolic move. Our chance to top would have been here. And if this is a parabolic move, then we need to see, you can see, if you think of this as a curve, we need to go much, much, much higher to get the next crash on this parabolic move. We need to go to roughly $50 to $75 in a short amount of time and then fall back to continue the curvature of the parabola. So I actually think that this breakout here is just a tiny percentage of the breakout that we need to make. As we can see, this failed and the parabola continues. So I'm looking for 50 to 75 before we get one of these, which is the breakdown out of the parabola. And those can be dramatic. Those can be 60%. But I don't think we're anywhere near that. We should have done that right there, and we didn't. So I'm looking for $50 to $75 before this parabolic breaks down. Now it will rise again. At $75, a 60% chop off that price is, we might fall back to $30, something like that, and then off to the races again into the triple digits. So I really think that we're going to, this move that we're on right here will probably run between $50 and $75 before we get a parabolic crash of this order. And just to reiterate, today's margin hike is really nothing. It's just the CME simply making sure that people put up at least 5% of the money they need to put up. And the market that rises faster than any other market is going to see more margin hikes than any other market. That's just the nature of it, because they're not done as percentages, they're done as raw dollars. So the bull market continues. We're looking for a move 250 and then beyond, and we'll talk to you next time.